Investing in real estate can be one of the most effective ways to build wealth and create a stable source of passive income over time. However, for beginners, the real estate market can seem complex and intimidating. In 2024, with the global economy undergoing constant changes and new trends emerging, it's more important than ever to understand how to start in real estate in a smart and secure way. In this guide, I'll walk you through a simple and practical step-by-step process on how to start investing in real estate in 2024. This guide is designed to help you avoid common pitfalls and make informed decisions from the start. Let's begin. 1. Understand the fundamentals of real estate investment. Before diving into the world of real estate investment, it's essential to grasp the basic concepts. The real estate market involves buying, selling, and renting properties, and can include residential, commercial, industrial properties, or land. Why is this important? Understanding the different types of properties and the factors that influence the real estate market, such as location, economy, and demand, will help you make more informed choices. For example, residential properties in high-growth areas tend to appreciate more quickly, while commercial properties may offer higher returns but come with greater risk. How to learn the fundamentals. Take time to read books on real estate investing, watch educational videos, and participate in webinars or workshops on the subject. Study success and failure stories to understand what works and what should be avoided. Summary. Understanding the fundamentals of the real estate market is the first step to becoming an informed investor. Learn about different property types and market factors to make safe decisions. 2. Define your investment goals. Before making any investment, you need to define your goals. What do you hope to achieve with real estate investing? Passive income, wealth building, portfolio diversification. Why is this important? Defining your goals will help determine the type of property you should buy, the location, the type of financing, and your investment strategy. If you're seeking passive income, for example, residential rental properties might be the best option. If you're after long-term appreciation, buying land or properties in developing areas might be more suitable. How to define your goals. Make a list of your financial goals for the short, medium, and long term. Consider how long you're willing to wait for a return, your risk tolerance, and the initial capital available. Summary. Defining your investment goals is crucial for choosing the right properties and investment strategy that align with your financial goals. 3. Assess your financial situation. Before investing in real estate, you need to evaluate your financial situation to understand how much you can invest without compromising your financial stability. What to evaluate? Consider your current income, savings, and debts. Calculate how much you can allocate for a down payment and ongoing costs, such as maintenance and taxes. Good credit is essential for obtaining favorable financing terms, so check your credit and work on improving it if necessary. How to do it? Create a detailed budget that includes all your expenses and income. Determine how much you can invest initially and how much you can set aside for emergencies. Be sure to include unexpected expenses that may arise, such as urgent property repairs. Summary. Assessing your financial situation is an essential step to ensure you have the resources necessary to invest in real estate in a safe and sustainable way. 4. Choose the right type of property. There are different types of properties in which you can invest, each with its own advantages and disadvantages. Property options. Residential. Houses, apartments, and condos are the most common and easiest to start with. They offer a stable passive income through rentals. Commercial. Properties like offices and retail spaces can offer higher returns, but come with greater risk and management challenges. Vacation rentals. Properties in tourist areas that can be rented out for short periods. They offer the potential for high returns, but with more volatility. Land. Investing in land is a long-term bet that can yield large profits if the area appreciates. How to choose? The choice depends on your goals, risk tolerance, and knowledge of the market. Residential properties are generally safer for beginners, while commercial and vacation rentals can offer higher returns with more complexity. Summary. Choosing the right type of property to invest in depends on your goals and comfort level with risk. Residential properties are ideal for beginners, while commercial and vacation rentals can offer higher returns. 5. Research the real estate market. Thorough market research is crucial for making informed decisions. Understanding the local market conditions where you want to invest can make the difference between success and failure. What to research? Location. Areas with high population and economic growth are generally good investments. Demand. Check the demand for rent or purchase in the area. Saturated markets can be risky. Prices. Compare prices of similar properties to ensure you're paying a fair price. Trends. Analyze market trends such as new constructions, infrastructure changes, or public policies that may affect property appreciation. How to do it? Use online tools to analyze the market, such as real estate websites, market reports, and public data. Visit the areas in person to get a real sense of the environment and talk to local realtors. Summary. Conducting detailed market research is essential for identifying good investment opportunities and avoiding pitfalls. Focus on location, demand, prices, and market trends. 6. Understand financing options. Investing in real estate typically requires some form of financing, especially if you're just starting out. Understanding the different options available will help you choose the best way to finance your investment. Key financing options. Traditional mortgage, common for purchasing residential properties, requiring a down payment of 20% to 30%. FHA Financing USA offers a lower down payment, around 3.5%, ideal for first-time buyers. Commercial financing, for commercial properties with shorter repayment terms and higher down payment requirements. Private loans, an option for those who have difficulty getting traditional loans, but usually with higher interest rates. How to choose? Consider your credit, how much you can pay as a down payment, and which option offers the best terms. Compare different offers and carefully read the financing terms. Summary. Understanding the financing options available is crucial to ensure you choose the best solution for your real estate investment, considering your credit and ability to pay. 7. Calculate the total investment costs. Before closing any deal, it's essential to calculate all the costs associated with real estate investment to ensure you won't be surprised by unexpected expenses. Costs to consider. Purchase price. The total value of the property, taxes and insurance. Mandatory costs that can vary depending on the location and type of property. Maintenance and repairs. Ongoing expenses to keep the property in good condition. Condo fees, if applicable. For properties in condos, these costs are unavoidable. Legal and administrative costs, including title fees, property registration, and attorney fees. How to calculate? Create a spreadsheet with all the costs involved, from the initial payment to ongoing expenses. Include a margin for unforeseen expenses, which are common in the real estate market. Summary. Calculating all the investment costs is essential to ensure you can cover all expenses and still make a satisfactory profit. Consider all aspects, from purchase to ongoing maintenance. 8. Find the right property. Now that you understand the market, have set your goals, and calculated the costs, it's time to find the right property to invest in. This step involves actively searching and making offers. What to look for in a property. Location. Prioritize areas that are growing or have the potential for appreciation. Condition. A property in good condition requires fewer initial repair costs. Appreciation potential. Check if there are infrastructure projects or developments that could increase the property's value. Rental income potential. If you plan to rent the property, estimate how much you can charge and compare it to the purchase price. How to find it? Work with an experienced real estate agent, use online platforms, and participate in auctions or real estate fairs. Don't rush. Finding the right property may take time, but it's worth the wait. Summary. Finding the right property involves research and patience. Focus on location, condition, appreciation potential, and rental income. 9. Conduct due diligence. Before closing the deal, it's essential to conduct due diligence, a detailed verification process of all legal and physical aspects of the property. What to check? Documentation. Ensure the property has all the paperwork in order and that there are no legal issues or disputes over ownership. Structural condition. Hire a qualified inspector to check the structure, electrical systems, plumbing, and other technical aspects of the property. Price history. Analyze the property's price history and the area to ensure you're not paying above market value. Income potential. Confirm the expected rental income and check if there are quality tenants in the area. How to do it. Work with qualified professionals, such as attorneys and real estate inspectors, to ensure everything is in order. Don't skip this step. It can save you from major problems in the future. Summary. Conducting due diligence is crucial to avoid unpleasant surprises and ensure you're making a good investment. Check the property's documentation, structural condition, and income potential. 10. Negotiate the purchase price. Once you've found the right property and conducted due diligence, it's time to negotiate the purchase price. Remember, the initial price is often negotiable. How to negotiate. Know the market. Use your market research to know how much similar properties are selling for in the area. Make a fair offer. Base your offer on the property's condition, your research, and the due diligence results. Be willing to negotiate. Stay firm, but be open to compromises. Sometimes, accepting a small concession can secure the property you want. Use an experienced agent. A good agent can be crucial in negotiating the best price and terms. Summary. Negotiating the purchase price is an important part of the real estate investment process. Use your research and due diligence results to make a fair offer and be willing to negotiate. 11. Close the deal and manage the property. Finally, after all the previous steps, it's time to close the deal and take possession of the property. After purchase, effective property management is crucial to ensure your investment continues to generate returns. Steps to close the deal. Contract signing. Ensure all documents are in order and that you understand all terms before signing. Property transfer. Ensure the property is properly transferred to your name in the land registry. Property management. Maintenance. Keep the property in good condition to ensure its appreciation and attractiveness to tenants. Leasing. If you're renting the property, ensure you select quality tenants and manage rental contracts and payments effectively. Ongoing review. Regularly review the property's performance in terms of appreciation and income to ensure it continues to be a good investment. Summary. Closing the deal and managing the property effectively is crucial for long-term success in real estate investing. Keep the property in good condition and proactively manage tenants and finances. Investing in real estate may seem challenging, but by following this simple and effective step-by-step guide, you can start with confidence and build a real estate portfolio that generates income and value over time. From understanding the fundamentals and defining your goals to finding the right property and managing it effectively, each step is crucial to ensuring your investment is successful. Remember, the real estate market requires patience and diligence. Don't rush into decisions, and always be willing to learn and adapt to market changes. If you like this guide, leave a comment below, like the video, and subscribe to the channel for more tips on investing and achieving your financial goals. See you next time.